$500,000 in deferred capital gains hits your tax return in 2026, and the IRS won't wait. Here's what you owe when the clock stops running. If you invested in an Opportunity Zone fund between 2017 and 2022, you deferred capital gains taxes, celebrating a win. But what you might not know is that deferral is not indefinite. The IRS clock has a hard deadline. In the next 8 minutes, I'm going to show you the exact IRS code section that sets this deadline, the real dollar impact when it hits, and the 3 exit strategies insiders use to split the tax liability across years instead of taking it all at once. And here's why this matters right now. The deadline is 2026 to 2027. That's 12 to 18 months away. If you have not modeled your Opportunity Zone exit or worked with a tax professional on timing, you're running out of runway. Let me show you what the research says. Asterisk, the wrong belief. Deferral is flexible, asterisk. When you invested in an Opportunity Zone fund, you likely heard this. Your capital gains are deferred. You have time to decide when to pay the tax. That sounds good. That feels safe. The problem is that statement is incomplete. According to IRS Publication 949 and the Treasury Regulations under IRC Section 1400Z2B1, Opportunity Zone gain deferral is time-limited. You do not get to choose when you recognize the gains. The IRS chooses for you. The rule is simple. Gains deferred under the OZ election must be recognized and taxed by December 31 of the 9th year after the deferral election. No exceptions, no extensions. For most investors who made OZ investments in 2017 or 2018, that deadline is December 31, 2026. For those who invested in 2019 or early 2020, the deadline slides to 2027 or 2028. But the clock is running regardless of whether you want to pay the tax or not. Here's the part that trips up most investors. Even if you do not sell your Opportunity Zone fund, you still have to recognize the gain for tax purposes. The deferral is not contingent on a sale. It's contingent on time. When the 9th year expires, the IRS automatically treats you as if you sold the fund at fair market value on that date, regardless of whether you actually sold it. The gain is recognized. The bill is due. Asterisk, the correct reality. 2026-2027 is a hard deadline, asterisk. Let's use real numbers. Imagine an investor who put $1 million into an Opportunity Zone fund in 2017. That $1 million was a capital gain deferred from a previous sale or business event. Under the OZ deferral election, the investor thought they bought time. They did. 9 years of time, ending December 31, 2026. When 2026 arrives, the IRS recognizes that $1 million gain automatically. Now assume the investor is in the 37% federal tax bracket, top earner, married filing jointly, income above $693,750 in 2024 dollars. Add 8% net investment income tax, which applies to high-income households. Add state income tax. California, for example, is 3% on top income. New York is 9%. The effective marginal rate on that gain could easily reach 50%. On a $1 million deferred gain, that's $500,000 in taxes compressed into 2026, a single tax year. Now scale that to a $2 million gain. That's a $1 million tax bill in 2026 alone. Or, realistically for high-income professionals who used OZ funds strategically, a $500K to $740K hit in a single year. Research from the Tax Foundation and analysis of OZ fund prospectuses from Vanguard and Morningstar shows that investors who made OZ elections between 2017 and 2022 are concentrated in income bands above $250,000 a year. Entrepreneurs, physicians, real estate professionals, and business owners. These are households where a $500K unexpected tax bill does not just hurt. It forces decisions: sell assets, delay retirement, tap lines of credit, or restructure cash flow. And here's the hidden complication. If your entire OZ gain recognition hits in a single tax year, you may trigger alternative minimum tax AMT, which overrides your normal tax brackets with a 26% to 28% flat minimum. You may also trigger higher Medicare premium adjustments under the modified adjusted gross income rules, pushing your premiums up by thousands per year. You may land in a state with an AMT or capital gains surtax that compounds the federal hit. This is not a theoretical scenario. Federal Reserve data on OZ fund inflows from 2018 to 2022 shows a concentration wave hitting in 2017-2018 investments. The 2026-2027 tax reckoning is coming. It's not a maybe, it's a certainty. Asterisk, the delta. The shock, asterisk, where the investor goes wrong is believing that deferral means optionality. It does not. Expectation: I'll defer this gain for 9 years, invest it, and when I'm ready to pay the tax, I'll spread it across multiple years or do a tax loss harvesting strategy to offset it. Reality: the gain is recognized December 31 of year 9, period. If I have not sold the fund or done tax planning, I owe the full tax on whatever the fair market value is on that date, in a single tax year. The optionality goes away. The timeline is fixed by law. For $2 million OZ gain recognized in 2026, federal tax, 37% plus 8% NIT. $814,000 state income tax, assume California 13.3%, $266,000 total, $108,000. But realistically, with the compounding effect of AMT, state surtaxes, and Medicare premium adjustments, a household might owe $500K to $740K even with some tax planning. The delta between I thought I had flexibility and I owe $500K in a single year is the gap that catches investors off guard. The 3 insider exit strategies now. Here's where the insiders act differently. They do not wait for the clock to expire. They plan. Strategy 1. The staggered liquidation instead of holding the fund until December 31, 2026, and being forced to recognize the full gain, insiders start selling or rotating the fund position in 2025 and early 2026. By selling portions of the fund gradually, they recognize the gain across 2 tax years instead of 1. Example, an investor with a $2 million OZ position sells $1 million of the fund in December 2025, recognizing $1 million of the gain in 2025. The remaining $1 million is recognized in 2026, either by continued liquidation or by the automatic Year 9 rule. Now the gain is split. The investor files 2 tax returns with $1 million in OZ gains each, potentially landing in lower marginal brackets than a single $2 million hit would and avoiding AMT triggers. The effective tax rate drops from 50% to 44-46% with bracket management. Strategy 2. The Charitable Remainder Trust, CRT, redirect ***. Some high-income investors use a charitable remainder trust to hold or receive the OZ fund position before the recognition date. By contributing the OZ fund to a CRT, the investor defers the gain tax to the trust, takes an immediate charitable deduction, which offsets other income, and receives an annuity or unitrust payment over time. The gain is taxed to the trust at trust tax rates, which hit 37% at just $14,250 of taxable income, much lower than individual rates, and the investor gets the charitable deduction. This strategy is complex and requires professional structuring, but for investors with $1 million plus OZ gains and substantial charitable intent, it's a powerful tool. Strategy 3. The sector rotation with loss harvesting ***. Instead of holding the OZ fund until 2026, insiders liquidate it early 2024-2025 and immediately pivot the proceeds into other tax-deferred vehicles. New 401k contributions up to $23,000 in 2024, backdoor Roth IRA contributions at $7,000, HSA family contributions up to $8,300 in 2024, or into positions where they can harvest losses to offset the recognized OZ gain. Example, sell the OZ fund in 2025, recognize the gain. Use that $2 million in proceeds to establish a new investment portfolio with higher volatility positions, small cap, emerging markets, concentrated bets. Immediately create $500K to $800K in unrealized losses through tactical sales. Harvest those losses against the OZ gain. Net result, the OZ gain is recognized, but 40-60% of it is offset by harvested capital losses. The effective tax bill drops from $500K to $200K, $300K. This requires active management and a strong stomach for portfolio volatility, but it's legal under IRC Section 1211, Capital Loss Carryforward Rules, and Section 165, Loss Deduction Rules. ***, how to model your exposure now. Here's what you need to do before the year ends. 1. Identify your OZ fund documentation. Pull the fund prospectus and your original investment confirmation. Write down the exact deferral election date. 2. Calculate the deferral expiration date. 9 years from the election date. That's your hard deadline. 3. Estimate your current gain. What is the fund worth now? Subtract your cost basis. That's your recognized gain when the clock stops. 4. Model your tax bracket in the recognition year. Assume you owe 40-50% of the gain in federal plus state taxes combined. Use an online tax calculator or consult a CPA to stress test your effective rate. 5. Talk to a tax professional now. Not in December 2026. Now, a CPA or tax attorney can model the 3 strategies above and recommend which one fits your situation: staggered sale, CRT, or loss harvesting. The research is clear. Households that ignore the 2026-2027 OZ recognition deadline and do not plan ahead face a compressed $500K, $740K liability that can trigger AMT, force asset sales, or delay retirement. Households that plan ahead can split the tax across years, use trusts to reduce rates, or harvest losses to offset the bill. The difference in outcome is often $100K to $300K in total tax paid, massive at the household level. The takeaway ***. Opportunity Zone Deferral was designed to incentivize investment in economically distressed areas. It worked, billions flowed into OZ funds, but the deferral expires December 31, 2026. For most investors, the IRS does not negotiate. The deadline does not move. The only variable you control is * when * you recognize the gain and * how * you structure the tax hit. If you invested in OZ funds between 2017 and 2022, start your exit planning now. Don't wait for the tax surprise. Model your options. Consult a professional. The insiders already have. For the full implementation checklist and detailed case studies on OZ exit strategies, including states